Good morning. No change of this morning's Bank of Canada interest rate announcement. As expected, they indicated that they wanted to pause and wait to see the impacts of, the jumbo rate hikes that we got over the last year. And there haven't really been any developments to tip the scales in either direction. But that said, extremely eventful month. Leading into the last Bank of Canada meeting, much of the upward rate pressure was from the U.S. Fed. Still talking hawkishly, still committed to raising rates. And as a reminder, the more the U.S. raises rates, the more pressure there is for Canada to raise rates to support our currency. If you don't do that, the loonie loses value versus USD. You need more loonies to buy products that are priced in USD. Basically, raises the cost of goods, makes inflation worse. Now, all of a sudden, about a month ago, bond yields started to tank, and there's all of a sudden concern about the stability of the U.S. banking sector. You had the 16th largest bank in the U.S., Silicon Valley Bank, fail, basically as their bond holdings were worth much less than what they paid for them. Mechanics behind that is interest rates go higher, the value of your bond goes down. So they had this massive bond portfolio, saw the biggest move in 40 years in interest rates. The bonds are worth significantly less. Word got out. Depositors all of a sudden get concerned that the bank won't have enough assets to pay them out, so they start to pull out their money. You see a run on deposits, run on the bank, voila, the bank is no longer. They weren't the only one. There's other banks that failed, but there was concern about the regional banking sector overall, concerns about the stability there. And make no mistake, when you see rates, when you raise rates as much as we have in the last year, it forces things to break. That is what the central bank want in a sense. That is how they will bring down inflation. And these problems haven't gone away. So that will definitely pose a challenge to the U.S. Fed continuing to raise. But that said, they did raise by 25 basis points at their last meeting. That came down from, they were floating around the idea of a 50 basis point hikes. They also changed their guidance from, being committed to ongoing rate hikes to some additional hikes, maybe. So they might raise again, they might not, but they're kind of easing off the brakes there. So overall, positive move for if you're looking for rates to come down in Canada. But in Canada, employment continues to be strong. Keep in mind that is, a lagging indicator. It tends to be the last shoe to drop before an economy enters recession. Inflation also continues to ease. Bank expects CPI to hit 3% by mid this year, although they don't expect inflation to hit 2%, which is their intended target, until the end of 2024. So we still have a ways to go there. I do think that our recently announced federal budget is going to pose a major hurdle to getting inflation down sustainably. Make no mistake, racking up more debt, increasing spending does nothing to help inflation in the near term. We have soaring cost of groceries, and it's great cutting people checks for $500 and all that, but let's not kid ourselves. That's not helping bring down the cost of groceries. If anything, that's doing the opposite. You're putting more dollars into a system to chase the same amount of goods that supports prices. The new first home savings account, tax-free savings account for first-time buyers in real estate, while I think it's an awesome program and have a link to it on my website, I think you 100% should participate in it. That is housing stimulus. That goes directly against what the Bank of Canada is trying to achieve. So all signs are pointing to, inflation remaining higher for longer in Canada, and that would point to interest rates overall being a lot higher than certainly they've been over the 10 years prior to 2022. In the near term, barring financial crisis, all signs are pointing to the Bank of Canada not dropping rates until 2024. Again, barring a crisis, which we're starting to see these things pop up. But I do think we're going to continue to see fixed rates, slowly settle down here throughout the year, as we've kind of seen in the last month. Like, fixed rates, a 3-year fix, we've been getting anywhere from like 4.6 to 5% in that range over the last month. Kind of depends on the day. But that's definitely, about 1% lower than where it was, 2 months ago. So big positive move in that sense. But if you want to chat about any of this, if you have a mortgage coming up for renewal, you're thinking about buying, feel free to get in touch. I'm happy to chat, and have a great day.